Microsoft added a new button to this slideshow screen, which is rehearse with a coach, and it uses artificial intelligence to, you can practice and it'll give you a critique of your presentation. It's really a pretty cool tool. And if you have kids that are, learning how to do presentations, it's a really good coaching tool using AI. So it's called the rehearse with a coach button on that. So let me see if I can get this going.
Did you use it?
You'll see in a minute. Not well. So I actually have.
Good morning, Steve. This is Ken. What program is that? Microsoft.
It's
Google
in Microsoft PowerPoint. You go into slideshow, and I'll actually pull it up again here.
Oh, that's cool.
You go into slideshow and it rehearse with a coach. And if I started rehearsing and started using ums and ahs, it'll give you instantaneous feedback. You can get the feedback at the end. So really pretty cool setup. So I have to get out of this now. So
just know it's showing us the same feedback, Stephen.
I'm sorry?
It's showing us the same feedback too. So
yes. So it's actually a pretty cool setup here. Now I got to get out of this 1 sec and go back.
Hey,
here.
Mark, before Steve starts, what's the dates you need for LA so I can get that done this week for you?
We're postponing that as the Super Bowl was unclear. We're doing it in April. I'll get that to you. We're talking about it tomorrow at 10:30.
Okay, cool. Happy New Year, everyone, by the way.
Same to you.
You too, Ken. So let's get started. The past 2 years have been anything but ordinary as this pandemic has reshaped our world. It's changed a lot of things, but it hasn't changed everything. And one of the challenges for us going forward is figuring out what's permanent change versus transitory change. And that's a dangerous word given the inflation discussions that are going on today. But there are a lot of transitions that are going on. And as we start the new year, it's clear that this world is far more complicated than it's been really at any point in time since March of 2020 when the first lockdown really hit. But you're having now this climate transition going on as we have this health crisis. At the same time, we're seeing population declines, a digital revolution. We're seeing mini bubbles that are correcting in whether it's the high multiple stocks and particularly the high multiple tech stocks with little or no revenues. What happened in SPACs, the large percentages of companies inside the indices that are selling for 30, 40% below their recent highs. And then you also saw it in some of the favorite areas of investing last year, including crypto. So you're seeing the global economies dealing with the complications that exist out there and are being created by this transitions and constant transitioning we go through with the reopenings and closings in the market. So today I want to just cover 3 areas: why the environment is so complicated, why we have a more positive view than the headlines would lead people to believe, and to share a divergent view that we have on the economy. So let's get started. So I'm going to touch on several of these areas over the next few slides, but clearly the labor picture is highly distorted right now. The inflation picture is distorted because of the supply chain disruptions and the lockdowns. We have a very uncertain health outlook, which is creating real challenges for policymakers due to the uneven health situation around the world with the vaccines and even the health systems to start. And then you have really unusual geopolitical tensions. So let's take a look at some of these issues one-on-one. So you actually have on one side, really strong labor market, we have, and a strong economy. You have, this is the jolts and the job openings are way above historical averages. And just going back to, the early 2000s, you can see just how elevated they really are right now. And that's creating distortions. You have the similar picture in the quit rates, where you have a really well above normal quit rate levels now. And the unemployment rate's now down to 3.9%. And a lot of that comes from basically the extraordinary economic support that the US has given that we touched on last week, but it's been what's gone on around the world. So there are a lot of cross currents that we're dealing with here. But when you go to the other side of it and look at what's happened from corporates and corporations and consumer net worth, just using consumer net worth as an example, We had almost a $20 trillion increase last year in consumer net worth in the US, closing in on $150 trillion of value. And just look at how high this has risen since the financial crisis in 2010. So big changes going on. That consumer net worth gives a lot of confidence to spend. It also has allowed consumers to, because of the support that's been given to the system, get their deleveraging. And Jamie Dimon touched on that yesterday. He said he doesn't think the consumers have ever been in as good a shape as they are now. And I think you're seeing that in the consumer confidence. But as some of the government stimulus gets pulled away and we make this transition, the question is the consumer and corporations going to be strong enough to take the handoff from the government to make this necessary transition? So we think they will be. So we're in a more positive camp than the headlines would lead people to believe. But I think that's due to two issues. One is we have a divergent view, but the other is people forget the discounting mechanism that the market is. And we're already looking at 6 to 9 months forward, and the headlines are just giving you what's going on today. So you really have to separate the two out and think about the future rather than the current, because what we're reacting to in the current is already in the earnings and in a lot of what is going on in the market. So let's just look at the key areas. And clearly the stimulus is a theme we've talked about for some time. A big part of that for us is that the accommodation has been highly excessive, and that's allowed a healing process to go on in the US and in some countries, but clearly we have a very divergent global system. The emerging economies are under a lot of stress. The US is driving global growth. China, which was the driver for global growth at about a third of the GDP increase, is now down to between 20 and 25% of global GDP increase on an annual basis. The US is really picking up the mantle for global growth leadership. We expect growth rates will still be very good this year, particularly because of the amount of stimulus that's already in the system. And even as we start to taper and accelerate the process to get to normalization, whatever that shape that's going to take, we think that the stimulus that's already in there is going to carry the system through certainly to the end of the year, but it's not going to be well shared. We believe that inflation pressures are already starting to abate in some areas, but will continue to abate. Clearly, the Port of LA is one of the big challenges in the global system. Certainly a big challenge that in the Long Beach for the US system, but we're going into a period where China is going to be slowing down their economy for the Olympics, but also because they have their one of their golden holidays that they take, which will slow activity over there, which will give our ports some time to clear the congestion. But the other thing to keep in mind is our ports on the West Coast are running at volumes that could be 15 to 20% higher than they were at pre-pandemic levels. So as we work through this process, we're going to have a very stronger, much stronger economy in our view. We think the supply chains problems ease. Rates, even though they have moved up considerably and very quickly, will remain historically low. We think the Fed right now is doing a good job of talking through some of their concerns and kind of reassuring the markets that they, even though they may be behind the curve, they're going to move very aggressively. And it will be interesting to see if they're talking up how quickly they'll move actually does ease some of the inflation concerns, and that they can actually jawbone their way to easing inflation concerns as the economy goes through their healing process. We think the big thing is that corporate earnings are really strong right now and should remain that way, but it's going to be hard to, people have to be very careful not to get whipsawed by the excessive focus on the short-term moves in the market. You want to own secular growers with strong growth prospects in this environment, and really want to avoid, in our view, the high multiples with no revenues, or these low multiple companies that have really earned their multiples by not growing for an extended period. So we think this is a challenging time, but if you stick to the secular themes, you'll do exceptionally well. We think the balance sheet expansion for the Fed will carry us through for some time. And as we look at what's going on and how this economy is going to work, our view is that the issues that are out there are going to be good for the US. Slowing global demand will ease the inflationary pressures. The Eurozone is going through some challenges as energy inflation weighs on them. Also, the geopolitical concerns are really a challenge there. And further adding to their problems, I think, is the failed state issue and the migration issues, creating even more social unrest that exists in these countries today. We're not as concerned about what China is doing to stabilize their economy while they're deleveraging, because that's a necessary part of the process for a company that's grown as fast as they have. There is some time that you have to absorb that growth rates. But lost in all this talk is how strong the S&P earnings are. And if we have another 14% year on top of the years we've had of the last couple, we could see surprisingly strong returns, although I don't believe they'll be broadly shared. We think the productivity improvement issue is going to be the determining factor for who wins and who loses in this environment. This manufacturing returning to the US is a big opportunity for us as a country and as an economy, and it's going to create some massive opportunities for companies in that area that can benefit from combining productivity enhancements with better supply and more resilient supply chain management. But we think the challenges are going to continue to attract capital from the rest of the world to the US, and that's going to create a big opportunity for us as we move forward. So not an easy environment. Clearly, a lot of fits and starts are going to occur this year, and it's going to be easy to get thrown off your investment strategy. But for us, it's one that you want to really kind of stay in the secular themes, avoid trying to time this market too much, and don't get sucked into trying to stay 2 steps ahead of what policymakers are going to do. Because if you think back last year at this time, we're talking about a massive stimulus program being put through for social infrastructure, and it looks like that has now been really cut down and maybe dead on arrival right now. So that also will ease some of the inflationary concerns that exist. So we could be moving back to what could be a more deflation-prone economy as well. So, Mark, I'll stop there and open it up to questions or comments. Did we lose Mark?
No, I just like having pregnant pauses once in a while. I think the whole world needs to live with the pregnant pause. So, questions, comments?
In terms of the port backlog and the data around that, you mentioned it's maybe showing growth from the pre-COVID period. Is there any other info you have on that front? Just curious how far backlog that is.
I saw a report comparing the port congestion and the port clearance from today and versus 19. And I think the volumes are up 20% versus 19. So pre-pandemic to now, we're actually, because of the shift in the economy, we've had to increase certain amount of goods coming in and on the good side. And that's actually shifted. That shift from consumers spending on services when the lockdown to goods has actually created an increase in demand. And I believe the number is between 15 and 20% higher volumes pre-pandemic to now.
So things like, I'm also guessing like cars, there seems to be, I don't know what the activity is in the auto sector, but I'm waiting for a new gas range somewhere in one of those ships. It's taking forever to order certain items. Just curious if there's any data on that, as far as specific sectors really having high demand because people have been waiting either because they've been hunkered at home or they just can't buy certain things because they're on backlog.
No, and Anand, let me bring it to closer to home. We're talking about pickleball rackets, getting pickleball rackets from China.
Yeah,
and it's part of our reshoring. But sorry, Stephen, you could give a more nuanced answer.
Well, it's actually interesting because you have a big divergence, because one of the things that's occurred right now is they're clearing up some of this congestion is we're unloading massive amounts of Halloween costumes right now, which can be used again this year if those hot items are still hot next year, which they usually aren't, but the bulk of the Superman costumes and all the other stuff you can use again, but it's the characters who are very popular for 1 year, you don't. But that's one side. The other side, and you mentioned autos, is the challenge in autos is the automakers are shifting chips to the higher revenue cars. So the less expensive cars are coming through at a slower rate because we can't get the chips to get them out. So there are nuances inside the system like that, which make these blanket statements about supply chains really dangerous. I think that's one of the things that I think, Mark, it was Eric who said at the beginning of the pandemic, be careful about getting sucked into the headlines because you'll get thrown off. And I think that is the case when you get into some of these supply chain challenges and what the congestion actually looks like and what it means. So I think you have to be really careful and look into it. There are certain areas that it's very different.
So to this point, we're going to have a cannabis event here in a few minutes, but we, while we were on, we saw this troops going into Kazakhstan. We were talking about Ukraine. We're having an event next week. Thanks, Adam Blanco, about get Eastern Europe theater. But why don't we have a supply chain? And let's just think. This is usually what we do on the 10:30 to 11. But I would ask our audiences to think of who you don't have to respond here, but let's just have a supply chain group. And I know what the head of just cue me and let's do a deep dive on that. We're doing trucking, which we'll definitely hit that on February 1st. All right, but I'll pause. Any other questions, comments?
Mark, I did have one follow-up, and maybe this is for Bill, but I heard Glenn Grossman on Friday, and he's suggested on the call that we could be 3 weeks away from peak COVID in the US. Have you seen statistics like that lately?
Bill?
Yeah, I haven't seen anything specific. However, if you line up what was going on in South Africa and you look at the timing of their curve and then you kind of adjust that to our curve, that sounds about right. I'm adding a little bit for us because we're bigger than South Africa, but I would say, yeah, within the next couple of weeks, we might be able to see a rollover in our cases.
So what is this telling us? This is, do we believe in that we've crossed a line here?
Yeah, so right. So this is the IHME forecast data,
Yeah.
and you can see that their forecast, was for peaking, just a little like last week. That's obviously what their model is showing, because today is to the right of the curve, or the peak of the curve. So maybe so. I think that their models have not been quite as good to pick up the volume of cases that we've actually experienced, which it's probably like the first time.
Is that confirmed?
Go ahead,
cases?
Mark.
Do I have that? Is that the confirmed cases tab that I show here now?
Yeah.
Okay. So that shows that we've fallen considerably, and that's what I'm hearing.
The UK is also, early numbers out of the UK look like they're following the South African curve as well, which I don't think the market is actually factoring in a peak in the pandemic at this point for the US.
Let's look at South Africa then. Give it a second.
Yeah. So you can see there that clearly they're on the downside. Other data that I've looked at shows the same type of curvature. Their hospitalizations and death rates are down. Actually, their death rate really never increased that much relative to the number of cases.
And Mark, do you have the UK there? Because that was the other one that Glenn was referencing on Friday.
Sure. Sorry, my screen is this way. That's why I'm turning. So it looks a little bit like the US.
Right. Yeah, the UK in particular has been hit hard. Their case curve does look very similar to what we have. Quite vertical.
I know it's anecdotal, but everybody in our families had it recently, the last 8 weeks, and our survey is similar.
Yeah.
Yeah, my wife got it in August, and we told her that she's got to catch up on the cycle so we can all travel.
Right. Yeah, no, there's my oldest finally got it. We know a whole number of people. You know, I think the good news is that, you know, once again, it's like a bad cold or, you know, a not so great flu, but not too much more serious. The other thing, I saw some data this morning about an increase in the number of cases of much younger children, which on its face is a little bit concerning. However, when you dug down and looked at some of the fine print on that data, is that apparently many of the children, unfortunately, who were admitted to hospital with COVID were also had obesity as a common characteristic among those admissions. So once again, if you have the so-called core morbidities, there we go. You know, you do have to be careful whether you're young or old.
Yeah. Everyone, I think we've talked about with some people on this call, we all have like somebody in the family who's very sensitive, and we all have to take extra protocols.
Right.
Okay. Any other comment? Go. Sorry. Go ahead, Bill.
Oh no, I'm sorry. I was just gonna jump back and ask Stephen about interest rates. So I mean, it's pretty interesting. You know, the 10-year was back in the range of pre-COVID, but you know, like at 177 or whatever it was the other day, and if people are looking for like 2.25, that's like it's only like another 50 basis points up, and in the big scheme of things, it's not that much. So I mean, I'm talking out loud, you know, with you, Uncle Stephen. You know, it seems as though the market is a lot more concerned about something that maybe it shouldn't be quite that concerned about. What do you think?
I'm in that camp. I think the yield differentials between the U.S. and the rest of the world are such that even when we raise rates, we're going to attract a lot of capital, which is going to push our rates back down again.
Yeah.
And the Fed actually has to be careful about the supply of treasuries as they reduce their balance sheet, that they may not be able to move as fast as everyone would like, just because they need to have a certain amount of treasuries in the system. So in our view, that we think the yield differential, the strength of the US economy, the debt problems in the rest of the world are actually going to continue to attract capital to the US, which will have the effect of knocking down the rates as we raise them. So I'm not sure we're going to get this big move up in rates. I don't think the global economy can handle it. I don't think the US economy with our debt loads will be able to handle significantly higher rates. So I'm also wondering if the inflationary pressures are easing the way we think they might be, whether they need to be as aggressive at that point after you take off the stimulus and have it run out through this year and maybe into first half of next year. You know, the economy is not going to be as self-sustaining at that point if the consumers and corporations don't pick it up. And I think higher rates would be the thing that would really kill that. We can't afford to have a housing blow up right now. I don't think the rate levels are enough to move it there, but you know, clearly we can handle a lower rate environment for some time, even with higher rates than we have now.
Sorry, Steve, one more question. Ken's got his hand up. So Ken, quickly, a last question.
Yeah, no, I might have just not heard it because I had a bunch of things going on in the car. But did you say that there were some manufacturing opportunities opening up because of all this in the U.S.?
Well, the U.S. has been reshoring for some time, and the fact that China's raised their wages as they have over the last 20 years for their manufacturing workers has made their advantage much less of an advantage. It's shifted it actually to other countries, but because of that, plus the supply chain, plus the trade war issues that we've had over the last several years, companies have been pulling stuff back closer to home for some time, and that is creating a strong economic activity in the Midwest of the United States in particular. And then there are certain areas around ports that you can see some, you'll still see some increased activities where we have a lot to do to get our supply chains fixed. So
look, we're going to transition here, but I'm gonna take the Anna, if I could, a little liberty just to transition. One is I have a great alumni connecting story right here. Just listen to this.
First found it. Well, I knew about pickleball. I'd heard about it, but I first really got into it. It was during the pandemic, and I was Zooming with my boyfriend's parents, and they live in Greenwich Village in Manhattan, and they moved the furniture in their small little apartment, shift pickleball court so they could play and stay active. They didn't go outside for months, and this is how they stayed active. And I looked into it a little bit more, and what I realized from them, and just otherwise, was that pickleball had a hold on people in a way that other games and sports and activities don't.
So it's a Denison alum who connects me to a Michigan alum. It's like a bullseye for me, and it's pickleball. She's in Cincinnati, and we just raised money for a feeder fund into Cincinnati startups, and we're tracking her. This is a karma, 100%. And then I'll pass it over to you, Anand. But just to let everybody know why I'm talking about pickleball. Obviously, we're here to talk about social equity, social justice, and cannabis, which is important. But you can also do that with pickleball. We're gonna try to take retirees to help young, kids, just as Jack Wyant does for squash. So there's a lot of great things we can do. So we'll